Okay, so we are looking at case 3 at the end of chapter 6 in the 5th edition Glenn Owen textbook for QuickBooks Online. All right, so the first few steps here in this case study are to create some accounts. Now, I already created these, but I want to show you how. So that first step, it says create a new fixed asset account with an account type fixed asset, detail type buildings, name buildings, and track depreciation of this asset. Okay, now taking from that, I'm going to have 2 separate accounts. I'm going to have the original cost account for buildings, and then I'm going to have the depreciation account, accumulated depreciation, and they need to be tied together under buildings. So this is what it'll look like at the end if you see this. Okay, so how did I do that? I create new. I clicked assets to help narrow down my drop-down list here. And I found buildings. Okay, so buildings is what it's going to be saved under. The tax form section is buildings. And so then I just titled it buildings original cost. And so it's not going to let me save it. But you can see when I started typing, it popped up here under buildings original cost. There's that account I created. Okay, then I needed the accumulated depreciation. So again, I selected assets. I looked under my long-term assets and I selected buildings is going to be the account that is the parent account. So I'm going to save this other account under buildings. The tax form section has to be changed to accumulate depreciation because that's what this account is for, and that's what I'm going to name it. Buildings accumulated, and I'm going to abbreviate just for the sake of how it looks. And you can tell mine pops up because I already created that account, but it's right there under buildings. So you create those 2 accounts, and that's that first step there listed. Then it says to create a new asset account with the account type other assets, detail type other long-term assets, name investments. And then again, this is a 2 account addition step here because you're going to change the name of interest paid to interest expense as well. So there's 2 different things you have to do in the second step. So first off, you're going to create that account, other assets, and I already created it, but again, I'm going to walk you through the process. So you create new. If you select assets up here, it narrows down the drop-down list. And then I can go other assets at the very, very bottom here. Again, it tells me what to put, other long-term assets, and I can put that name investments, and mine's already popped up there. And then I found that interest paid account. So you have to look down here, go through your list, and then I changed it to interest expense as they told me to right here. Okay, so that kind of helps us get started with the different accounts. The third step is just to verify that your owner's equity account is in your chart of accounts, which it should be if you already have used it in past chapters. But then step 4, record the purchase of new equipment. And so I want to point out here, whenever it gives you a check number, so this says new equipment purchase from Staples Inc., check 323. That means you are going to create a new check. So you're going to go new and under vendors, select check. All right, and so then you can fill it out, fill out that check information. As you can see, I did here, check 323, payee is Staples, and that is machinery and equipment, original cost. Okay, then you also have on step 5, it gives you another check number. So after you get done with that, you could just go save and new, and then come up with another check. You're going to again fill that out as the book tells you. You're going to create a new vendor, E-Trade, and the category is investments. So under category, put investments, the amount, $5,700. And there's that check. Okay, you're also going to record an owner's contribution. So this was immediately deposited. So what I did is I used a bank deposit. I went new bank deposit. And then what I'm actually going to do here is just pull up what I had filled out to show you. So this bank deposit is received from owners. So I created a new vendor there. The account is owner's equity and the amount $40,000. It was immediately deposited into our checking account. So that's why I did a bank deposit to checking. Then step 7 says record the deposit of funds from a new note payable signed on with Chase Bank in the amount of $32,000. So again, it was a deposit into our checking account. This time the vendor was Chase Bank. The account is notes payable, $32,000. All right, and then it says record a payment. Okay, so if I'm recording a payment, that means I'm going to pay someone. I'm writing a check. So I went new, check once again, and wrote check 325 to Rabobank. Now with this, notice we're paying on the note payable $23,000, but then we also had that interest expense, $300. And so the total of our check is $23,300. And then this next step is where I wanted to really make sure we got here in the video so I could show you. All right, so this case, it says record the purchase of a building from Leeds, which is a new vendor, in exchange for a note payable. So we're not writing a check. What we're doing in this case is we're going to be having to create a new journal entry. Because we're not writing a check, we're not paying for this out of any of our accounts, we are bringing on a note payable. So what we're doing is we're signing a loan for this building. All right, so in this journal entry, and again, I already completed it, so let me just pull up what I had. You can see that I used buildings original cost, right? This is the original purchase. And so the debit goes to the asset, which we are adding, which is the building at its original cost of $31,800. Now we purchased this building from Leeds. So I went ahead and included Leeds as the vendor for both lines here. And then the other line, because there's always two sides, every single journal entry is going to have equal debits and credits. So the credit in this case is the notes payable, the liability that we are adding to. So we are crediting notes payable $31,800. And so our debits equal our credits. This is a complete journal entry. And it shows that we have added an asset of buildings in exchange for also adding liability or debt that we will pay. Thus, it's called notes payable. We'll pay that back to the bank or the lending institution. And so that's why it's called notes payable. Okay, so then that was the last transaction in the case study. You will go through and open and save some different reports and upload those to your Canvas course so I can grade them. If you have any questions along the way, let me know. Thank you and have a great day.